Tax season is here, and we're all hoping we don't need to pay more in taxes than we need to. So what can we do to pay less in taxes?
Did you just boot my stroller?
Nicholas Wilde, you are under arrest.
For what? Hurting your free wings?
Felony tax evasion.
Of course, legally. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, a channel dedicated to helping the standard generation master money and achieve financial security. In this video, I want to cover 6 completely legal and most common ways to lower your taxes, so you can keep more money in your pocket rather than giving it to Uncle Sam. Number 1 is to contribute to your retirement account. This is by far the most common and the easiest way to reduce your taxable income. When you contribute money into a traditional 401k and IRA account, what it does is that it reduces your overall taxable income, which in turn reduces the federal tax that you owe. For example, let's say that you make a gross $100,000 a year. If you don't contribute anything to your retirement account, you'll owe federal tax against that full $100,000. This comes out to about $18,000 in federal taxes for a single filer. But if you're to, let's say, contribute $20,000 into your retirement account, your taxable income is now reduced to $80,000. Now you only owe about $13,000 in federal taxes versus the $18,000. A $5,000 in savings because you decided to contribute to your retirement account. And that's not the best part. By contributing into your retirement account, your money is also growing tax-free until your retirement. A double win in my books. If you don't take advantage of contributing into a retirement account, you're missing out. The max contribution limit for 401k in 2022 is $20,500. And the IRA is $6,000. If you have the ability, max out these accounts so you can not only reduce your taxes, but save for retirement as well. A second way you can reduce your taxes is by opening up a health savings account, also known as HSA. I speak more about the power of HSA in this video here, but in a nutshell, it is a savings account for your medical expenses. Now, there are a few benefits to this I want to highlight. One is that when you contribute money into an HSA, similar to a retirement account, your taxable income is reduced by that amount. The contribution limit for 2022 is $3,650 for self-only coverage and $7,300 for family plans. This means that you as a family, when you contribute $7,300 into an HSA, you don't pay taxes on that amount. And it gets even better. The money within HSA, if invested, which I highly recommend you do, will not only grow tax-free, but you can withdraw tax-free for any qualified medical expenses. But wait, there's more. There is no time cap to HSA, which means you can hold on to your medical receipts from 10 years ago, and if you want to withdraw tax-free money today, or 10 years from now, you can. Now, a caveat here is that you do need to have a high deductible health insurance plan to be eligible to open one of these accounts. So make sure you check on that. Again, I have a video where I go into the power of HSA where you can learn more, and I'll have a link in the description below. But the bottom line is this: if you're eligible, don't miss out on this amazing account that will not only reduce your taxes, but increase your net worth as well. Number 3 is HSA's not so good looking younger brother, the FSA, the flexible spending account. If you don't have a high deductible health insurance plan, you can still pay for medical expenses with tax-free dollars if your employer offers flexible spending accounts. Most often, you enroll as a part of your employer's benefits package. Once you enroll, the FSA amount is deducted from your payroll automatically into a separate account, which can then be used to pay for expenses running from insurance copays to over-the-counter medication. One downside of FSA compared to an HSA is that they have an expiration date. If you don't spend all the money within the FSA within a specific year, the amount is forfeited. Many employers also offer FSAs for both healthcare and dependent care. Dependent care can be used not only for your kids' preschool or after-school expenses, it can also be used for elder care as well if you're caring for your aging parents. This is especially beneficial for us as a standard generation. Check with your employer on the details, but this is another low-hanging fruit that you want to take advantage of to reduce your taxable income. For us, given we have 2 young kids, the FSA literally saved us thousands of dollars in taxes the past 10 years. Don't leave money on the table. And if you like additional resources to help you better manage your finances, go to my website at financialtortoise.com and download your free copy of Standard Generation's Guide to Financial Security. 10 steps securing your family's financial future. I'll have a link in the description below. All right, moving into number 4. We're now getting into less common, but still smart ways to save money on your taxes. If you have a side gig or a side business, you're eligible for a lot of tax deductions. You definitely shouldn't start a side gig just for tax savings, but hey, it's a great side benefit to getting your passion project up and running, right? A few of the business deductions available include office supplies, shipping, advertising, website fees, professional publication, and even a percentage of your home internet charge. charge. When I was working full-time and running my website on the side, I was able to deduct all the educational books I purchased because they're all contributing to improving my side business. To be honest, I would have purchased those books regardless since I love reading, but having a website that I was running was a great way to get a tax write-off on these expenses. There's a lot of nuances to deducting business-related expenses, so you want to work with an accountant on this, but the IRS rules are in favor of helping entrepreneurs get their business up and running. So if you've been thinking about starting a side gig, don't wait. Mr. IRS is also rooting for you. Number 5 is to sell your losers.
You talking to me?
No, not your loser friends. Though if they aren't helping you move forward in life, you might want to start creating some healthy boundaries. I mean in your taxable investment account. If the market took a dip this year and you have losses in your taxable investment account, cut them loose before the year end and use the losses to offset capital gains income. If your overall losses exceed your gains, you can deduct up to $3,000 from your other taxable income. And even better, the losses that exceed that amount can be carried forward for future years. One caveat is that once you sell and you buy back the same stock within 30 days, your deduction will be withdrawn by the IRS. So you want to be very careful when using this strategy. Number 6 is my personal favorite. Contribute to a charity. Charitable contributions are tax deductible and they don't even have to be cash. If you ever donated clothes or household items because you're cleaning out your garage, you can deduct them against your income. Make sure you get a receipt though. If you regularly donate items to Goodwill or the Salvation Army, this is an easy way to reduce your taxes while at the same time getting rid of items you don't use anymore. In addition, any donation you make to your church or your favorite nonprofit are also tax deductible. Similarly, make sure you get a receipt though. There is a hack that I've used if I don't have a specific nonprofit I want to donate money to yet, but I still want to take advantage of the deductions that come from charitable contributions. Donating money to a donor advised fund. Donor advised funds work like a mini foundation that allows you to contribute money like any other investment account, and you get to take the tax deduction the year you contribute money. If you want to learn more about these DAFs, check out my video here about donor advised funds where I go more into details. Thank you guys for watching, and I'll see you in the next one.